Hi, this is Danny Brown with Myriad at My Home Group, and this is So You Want to Buy a House. Today, we're going to be talking about getting your finances in order. So the first thing to getting your finances in order is checking your credit score. You don't necessarily want to pull your credit yourself to look at it, but you do want to make sure that your credit score is in line, and a lot of people think that you have to have a much higher credit score than you actually do in order to qualify for a home. So the lowest credit score right now that lenders are accepting is about a 580 FICO score, which is actually pretty low in terms of credit standards. So with a 580 FICO score, you can qualify for FHA financing. And what an FHA loan is it's a federally backed loan guaranteed by the US government. So lenders feel a little bit more comfortable accepting borrowers who have a slightly lower credit score. Now, if you're looking to do a VA loan, so say you're a vet from the military and qualify for VA financing, you're going to need to have a 600 FICO score. And if you want to qualify for conventional financing, so a traditional mortgage, you're also going to need a minimum of a 600 FICO score. If you don't have those credit scores in line or you're kind of on the bubble, there are some things that lenders look at that can still get you qualified. If you have a larger than normal down payment, then the credit score may not be as sensitive. If you have a very long job history, so if you've been at your employer for longer than 2 years, that absolutely helps you. In addition to those items, lenders are also going to look at what's called your debt to income ratio. This is how much debt you currently have to how much money you're making. So they're taking into consideration your credit card debt, any auto loans that you have, student loan debt, just any debt that you currently have versus the income you're making, and what that introduction of a mortgage will do to that ratio. So you have to be below a certain percentage point in order for them to finance you. So it really comes down to what you qualify for, how much debt you have versus how much income you make. So the next thing you want to do is actually reach out to a lender. Now, I recommend reaching out to multiple lenders because they all operate a little bit differently. They all charge different fees and have different fee structures. And it really comes down to who you click and who you mesh with the best. They're going to be asking you a ton of personal and financial questions, so you have to be very comfortable with the individual that you're working with. I wouldn't just shop based on price alone. I would base it on price. I would also base it on your comfort level with that individual and the level of service that you think that you're going to get from them. I would shop and look on review sites such as Yelp to see other people and their past experience with your lender as well, because that can be a really good sign of what you can expect in the level of service that you can expect from your lender. The first thing that you should find out from your lender is not how much you can borrow, but rather they should ask you, what do you want your monthly payment to be? You don't want to be house rich and cash poor. You want to be able to comfortably and enjoy where you live, but you also want to be able to enjoy your life and still do things and go out to dinner. And if you're spending it all on your monthly mortgage payment, that can really affect your living situation and the joy that you have, in doing fun things. Some other things to look for when you're meeting with lenders is you want to look at what their origination fee is. A lot of lenders have different fees that they charge for doing their loan, and that's a really good way to kind of differentiate between lenders. And then you're looking for transparency. Ask them for a complete cost breakdown of what they're going to charge you in terms of points and fees, so that you're not surprised by anything that shows up at the end, and so that you can compare really apples to apples when it comes to lenders. They should be providing you with what's called a good faith estimate, and that's basically a breakdown so that you can look and you can compare the lenders side by side to see who's giving you the best deal. And then what people often don't think about, contact the other lender if somebody else has given you a better deal. They will price match, and sometimes they'll even beat the price of the other individual, and then go back to the other one and start getting them to bid against themselves in terms of pricing so that you get the best deal possible. Some of the additional costs that you should review and just be prepared for that as they come up is going to be your appraisal fee. There may be a wire transfer fee. There's also going to be title and escrow fees that you have to pay. So make sure that they're accounting for all of those things. Taxes and insurance, homeowners association fees are another one. So there are fees that aren't necessarily charged by the lender, but should still be accounted for as kind of a rough estimate on that good faith estimate so that you can kind of be prepared for what you're going to be spending on not only getting the loan, but on a reoccurring basis as well. And after you sit through all of that and it turns out that you're not quite ready to be able to buy a home, if it's a good lender, they should be able to either put you on a credit repair plan. So if your FICO score is not where it should be, they should help you get to that point and know how to do it in the shortest amount of time possible, or set you up on a savings plan, helping you put aside enough money so that you're able to purchase that home in the shortest amount of time possible. So good lenders will help you get to where you want it to be. They don't just tell you, oh, I can't qualify you and expect you to come back when you're ready. They'll help you get to where you want to be in the most efficient time possible. If you are approved for a loan and you like the individual that you're working with, then get what's called a pre-qualification from them. This is going to be a form that states what you're qualified for, and your realtor is actually going to need a copy of this. Most sellers, in fact, some sellers won't even allow you to view their property unless you have that pre-qualification form in hand showing that you're a ready, willing, and able buyer. And then in addition, most buyers won't even accept an offer from you without that pre-qualification form in hand. I know it sounds backwards that you have to get qualified for your mortgage before you find the house that you want to buy, but that's really the process. So go through all of that, meet with the lender, get your qualification in order, and then start looking for your home. And then it's also important during this entire process to keep your credit stable. So you don't want to take out any new forms of credit. I know it's tempting when you're shopping for a house that sales will come up, you get no interest financing on that nice refrigerator, washer and dryer for your new home. Don't do it, because you're changing your credit scenario and you can affect your rate, which will then, you can affect your FICO score, which then can affect your rate or even your ability to qualify for your mortgage. Don't buy any cars. Don't close any trade lines. A lot of people will think, well, I'm going to close a bunch of credit because that's going to help my debt to income ratio. Don't close any of those credit lines. Like, for example, I have a Best Buy credit card that I haven't used in years, but I got it when I turned 18 years old. If I was to destroy that and cancel that card, I'd lose all that good credit that I built when I did actually use it. So it's really important. Don't do anything with your credit. And if you are, and you have to, reach out to your lender first and tell them what you need or you want to do so that they can make sure that you can do it and not disrupt qualifying for your mortgage. And then I know this might go without saying, continue to pay all your bills on time. You don't want to have any late payments show up or anything go to default when you're shopping for a home and trying to get qualified for a mortgage, because that also can ruin the possibility of having a good interest rate or even qualifying. Thanks for watching So You Want to Buy a House. If you guys need anything at all, have any questions, please feel free to reach out to me, and we'll see you in the next episode.